Hello everyone. In this video, I will briefly introduce what is the concept of so-called weighted average cost of capital, and I will introduce the component of those weighted average cost of capital. I don't think we will move to the calculation of so-called WACC or weighted average cost of capital. I will just introduce each component first, and the next video I will do the calculation. So this chapter actually is a review of what we learned in the previous chapters. So as we know, for a multinational corporation or domestic corporation, they have three kinds of method to raise funds. Their capital either comes from debt, either short-term debt, which is the notes payables, or long-term debts, which is more like a corporate bond, as we learned before. So remember, for corporate bond, the yield to maturity, we label it as RD. And for yield to maturity, it's the yield given by the borrower firms to the investors. It's also the cost of the debt. So basically means that when you borrow from the investors, you have to pay something, and that's the cost. You pay the yield to maturity, that's the cost by issuing debt, by using debt capitals. Preferred stock, the interest, remember the interest of the preferred stock is RP, which is also with the cost of preferred stock. Or which is also the return. The cost of preferred stock is from the perspective of the firm, and then from the investor's perspective, that's the yield of preferred stock. Basically, it's the interest you received from the firm. And finally, common equity, we label it as RS, which is the cost of equity, because stock, this is called equity capital, or which is the return to the investors. So as we know, the capital from a lot of firms, especially US firms, their capital from all three sources. There's part of the capital from debt, part of capital from preferred stock, and part of capital from common stock. Then you have a lot of cost, the cost of debt. This is the cost to use debt capital. You have the interest, the investment return or cost you have to pay to your preferred stockholders. Also, you have the cost of equity, which is the cost to use the equity capital. Then how could we find out the cost that the firm has to pay to use all three types of capital? We introduce this concept, so-called weighted average cost of capital. The weighted average is exactly the same concept we seen before. Weighted average expected return, weighted average beta. The return on assets basically depends on the risk of assets. Remember, that is the risk-return trade-off. So if you have a higher risk, you have to pay the investor higher return, which means you have higher cost of capital. So return to an investor is the cost to the company. Our cost of capital provides us an indication how the market view the risk of the company's assets. The assets are all funded by the capital from three sources again: debt, preferred stocks, and common equity. So the required return basically is the same as the appropriate discount rate, and it's based on the risk of cash flows again. Then after you get this weighted average cost of capital or proper discount rate, so this is the same thing. The proper discount rate basically is the cost to use capital. And then we can use this discount rate to determine whether the project add value or wealth to other firm, or it's actually cannot contribute wealth or even make the firm suffer loss. So there's some rules to determine whether it contributes more wealth to the firm, like NPV rules, which is net present value, and IRR rules, which is internal rate of return. We will learn those two capital budgeting rules in next chapter. So in this chapter, our task is to find out this proper discount rate or cost of capital. So the cost of capital, again, all the firms, usually majority of the firms has three sources of capital: debt, preferred stock, and common stock. And for debt, the cost of debt basically is yield to maturity. So let's label it here. So cost of debt is yield to maturity, which means the firm has to pay investor yield to maturity to use those debt capital. And how could we find out the cost of debt? We needed to find out the corporate bond and then find out the yield to maturity. And when they use preferred stock, which is the RP for preferred stock, and then for common stock, which is RS, remember, this RS is the required rate of return. So you know how to calculate those RD, which is the cost of debt here is RD. How to calculate RD, RP, and RS, we already know. We learned it in previous chapters. So here, this chapter is just put all those information together and find out an average cost of all those capital sources. So let's look at this firm called Common Technologies. It has a long-term debt. It's a 15 years, 12% coupon semi-annual payment non-callable bond. And the bond price is 1,153.72. And this company also has preferred stock, and it's 10%. This 10% basically means the preferred stock dividend. This is a dividend equals to 10% times the face value is $100, is $10. And it's a quarterly dividend. So each quarter, the dividend is $10 divided by 4. So it's $2.5. And the price of the preferred stock is $111.1. And the firm also has common stock price. The common stock price is $50. It gives you today's dividend is D0 and the growth rate. And it gives the firm's beta. Remember what is beta here? So this is firm's beta, risk-free rating, and market risk premium. And this market risk premium actually, remember, is RM minus risk-free rate. It's 6%. Tax rate is 40%. Now the corporate tax rate is relatively lower. It's around 15%. But we still, here we assume it's 40%. And it gives the so-called capital structure. What is capital structure? So remember when we calculated the weighted average expected return, the weighted average expected return has this weight, like what's the percentage of capital you invest in a single stock. Here, the capital structure is the same thing. So basically, it's like what's the percentage of capital from debt? What's the percentage of capital is from preferred stock? And what's the percentage of capital is from common equity? There's three types of capital structure. The first is called the book capital structure, book value capital structure, which is based on the accounting data. And the second one, basically accounting data are all historical data. And the second one is market value, which is the data from market. Like what's the market value of your debt, what's the market value of your stock price. And then this is the current data. And the last one is target data. This will be the target capital structure is discussed in the financial statement, in the annual report. And this is the futures data, the projected data. So which one is the best? The target one is the best because we use those, we use the capital structures and the cost of capital components to find out the weighted average cost of capital. And how can we use the weighted average cost of capital? We use it to discount the future cash flows, then to determine, make decisions whether we accept or reject the project. So the decision is in the future. So that's the reason the future capital structure is the best. If this is not available, this is the second best one, which is the market value. If we do not have market value capital structure and target capital structure, the last one, we have to use the book value, right? But this, we do not prefer this. The best one is still target capital structure. So let's focus on this company, this so-called common technologies. First, we needed to find out. Here we have the target capital structure weight. We need to find out the cost of each component. Basically, it's the return for each component. So the first one, cost of debt, which is the return to the debt investors. It's the yield to maturity one. So again, it's a yield to maturity. It's not a coupon rate. So the long-term debt. This long-term debt for this company is 15 years, 12% coupon semi-annual payment. The bond price is 1,153.72, which means, because it's a semi-annual, so which means the total coupon number is 30. And the 12% coupon, which means the payment equals to 12% times 1,000 divided by 2, so which is $60. And the future value, which is par value, it didn't mention here. We assume it's 1,000, and the present value, remember, it's negative because that's, you have to pay the price, then you can receive the coupon payment and principal. The negative sign here means it's cash outflows. So then we can solve this yield to maturity for half a year. This is for half a year, equals to 5%. So this yield to maturity, annualized the yield to maturity is 10%, which is also the cost of debt capital. So because this is the yield to investors, from the firm's perspective, it's a cost. They have to pay 10% each year to their investor so they can use this debt capital. And here is another example to calculate the cost of debt, RD. Again, RD is yield to maturity. It's a 25-year, it's a long-term debt, and the coupon rate is 9%. Remember, coupon rate, RD is not coupon rate, it's yield to maturity. Coupon rate is used to calculate a coupon, and the coupon are paid semi-annually, which means the payment equals to 9% is the coupon rate times 1,000 par value divided by 2, which is $45 per half a year. And the bond price is 908.72. Remember, this is a present value and it's negative. Future value is 1,000. And N is 2 times 25 years. So in total, you will receive 50 coupon. So you will find RD, again, what you get because it's semi-annual, this is for half a year. And RD is 10% each year. So the cost of debt, the firm have to pay 10% each year to their investor so they can use this debt capital. So the next component, we found out the cost of debt is 10%. So basically the firm has to pay 10% to use the debt capital. Next component is preferred stock. So what's a cost for the firm to use the preferred stock? So remember, the preferred stock preferred stock is a perpetuity. The dividend is perpetuity. So the interest rate for the preferred stock, we can solve by this formula. This is the dividend of preferred stock, and divided by the price of the preferred stock. And this is the cost of preferred stock. So the firm has to pay this interest so they can use the preferred stock capital. So remember, the dividend is 10% per year, because for here, even each quarter is 2.5. We still want to annualize the cost of preferred stock. So if we found that each quarter preferred stock, we have to times 4. So it is still equals to 10 over this 111.1 is equal to 9%, which means this 9% means the firm has to pay 9% per year to the preferred stock holder. To use this capital, preferred stock capital. So try to refresh your memory. Companies do not require to pay preferred dividend. However, they try to pay it for 3 reasons. First, if they skip preferred stock dividend, they cannot pay common dividend. And if the investor found they frequently skip preferred stock dividend, they will not invest in the preferred stock together with common stock for this firm of this firm. So it makes the firm really hard to raise additional funds. And sometimes, if they keep skipping preferred stock dividend, the stockholder will choose, will elect 1 or 2 board members so they can to represent their benefit, represent the preferred stockholders, and so they may gain control of the firm. Another example as a practice, if your firm has preferred shares with an annual dividend of $3 and the current price is $25, the cost of preferred stock will be 12%. So the last component is the cost of equity, which is what's the interest rate or the percentage rate of return the firm has to pay to use the common equity capital. There's two methods to determine it, which is RS here. The first we use campaign model. Remember, RM minus RF. This is the market risk premium. And the advantage, because here we use beta, so it's adjusted for systematic risk. All the firm, as long as you have returns to calculate beta, you can use this campaign model. Disadvantage, you have to estimate this market risk premium. It's a very hard task, and it varies over time. If you have the really bad estimation of market risk premium, you get the, your RS is very inaccurate. You have to estimate beta, which is also a hard task because you need the historical data number together with the historical market return numbers, and it varies over time too. And again, we use all the historical data, historical stock returns together with the historical market returns, and those it's hard to predict the futures. Sometimes it's not very reliable. In the future, the beta of the firm changes a lot sometimes. Second method is DCF, which is discount cash flow. You need to know the dividend, right? The firm has to pay the dividend. First, it's easy to understand and use, but only applicable to companies who pay dividend. If the company didn't pay dividend, like the new company, it's hard. Second, the dividend has to grow at a relatively constant rate. If the dividend, like new firms, growth firms, those firms can the dividend increase in a varied rate, not a constant rate. We cannot use this model. Also, it's very sensitive. You need has a really good estimates of growth rate, and it doesn't consider the risk. So it's not like campaign include the beta, which is measures the systematic risk. For these common technologies, the stock price is 50 D0, which is today's dividend is 4.19. It gives you growth rate. It also gives you beta, market premium, and market risk premium and risk-free rate. So use campaign, we find out that RS is which is the cost of equity. The firm has to pay 14.2% to their investor to use this common equity capital. Or we can use DCF to find another number. Those two numbers are not the same. We just use the average of it, which is 14%. Here's some example to illustrate how to calculate the cost of equity. So use the campaign model. In this case, it gives you the risk-free rate, market risk premium, and the beta. So we just import those numbers in the formula. We find the cost of equity is 12.5%. Or we can use the DCF because it also gives you the dividend. Here it gives you D1. It's even better. And the P0, today's stock price and the growth rate. We find out the RS is 11.43%. The difference between highest and the lowest. This is highest because we only have two estimates. This is the highest, and this is the lowest. The difference is just the highest minus lowest is 1.07%. Next example, Boyson Inc. Perpetual preferred stock sells for $97.5. This is the price for the preferred stock, and the dividend is $8.5 per year. Then the rate of cost of preferred stock is the dividend divided by price. It's 8.718%, which means the firm has to pay 8.718% to the investor, so the firm can use the preferred capital. And the next example, suppose that your company is expected to pay a dividend of $1.5 per share next year. There has been a steady growth in dividends of 5.1% per year, and the market expects that to continue. So basically, market expects the growth rate is 5.1%. The price is 25%. What's the cost of equity? So we use the DCF model, and we found the cost of equity is 11.1%. The next one, we use CAPM because we have beta, risk-free rate, and market risk premium. And remember, the market risk premium again is RM minus R risk-free rate. So we find that the cost of equity is 11.088%. Next example, suppose our company has a beta 1.5. So when you see beta, usually means you can use CAPM. Market risk premium is 9%. So this is RM minus R risk-free rate. Current risk-free rate is 6%. We know that RM actually equals to 9% plus 6% is 15%. And we found that we have used the analyst estimates to determine that the market believes our dividend will grow at 6% per year, and our last dividend, which is D0, equals to $2. And it gives you P0, that is the current price of the stock. What is our cost of capital? We can use two methods. Use CAPM, so we use this beta, risk-free rate, and the market risk premium. So we found that the cost of equity is 19.5%. Use DCF, we found out the cost of equity is 19.55%. So we take an average in this case. Add them together, divided by 2. So the cost of equity is 19.525%, which means the firm has to pay around 20% to the equity investors so they can use the equity capital. The investor will be willing to invest in the firm. If the return is less than this, the investor will stop investing in the firm. So we can put all the information together, and then we can calculate this so-called weighted average cost of capital. We have all those three sources of capital. What's the average cost of the firm to use those capital? And it's a weighted average. So this is the weight of that. Then RD, remember, is the yield to maturity. And because the interest rate has a tax deductible, so we use after tax one. So it's 1 minus T. And this is the weight of preferred stock. Like what's the percentage of capital is funded by preferred stock. And then RP is the cost of preferred stock. And the RC is the weight of common stock. And RS is the cost of equity or common stock. So again, we use the target capital structure weight. That is the best. And for this company, we know that This is the target one. 30% of the capital is from debt, 10% from the preferred stock. Common stock, that's 60%. And we found that pre-tax cost of debt is 10%. Remember, this is RD. The cost of preferred stock, which is RP, is 9%. This is what we calculated before. And cost of equity is 40%. Then we just plug those numbers. So 13% plug to this RD, WD, weight of the debt. RD goes to here. The tax rate here is 40%. This is given here. And RP is 10%. WP is 10%, is from the target capital structure. RP is 9%. And finally, 60% is funded by common stock. So WC is the weight, the capital percentage of capital from common stock, and RS is 14%. And finally, we found that weighted average cost of capital of this firm, Common Technologies, is 11.1%. So here's some questions related to the cost of equity. First, the cost of equity used in capital budget should reflect the average cost of various sources of investor-supplied fund in the firm used to acquire assets. That's true, because we include the debt, preferred stock, and common stock. We include all the sources of capitals a firm used. The before tax cost of debt, which is lower, actually remember the before tax of the Common Technology is 10%, and the tax rate after the tax rate is 40%. So after tax cost is 10% times 1 minus 40% is 6%. Actually, before tax, which is higher than the after tax, and again we use the after tax in the weighted average cost of capital. Because we use RD times 1 minus T, which is after tax cost of debt in the weighted average cost of capital. So I think I'm gonna stop here, and all the examples I will talk about them, explain them in next video. Thank you.